Yes, please start.
Hello everyone, Michaela here from Huobi Global with another episode of Huobi Live. Today I'm very excited because we have Adrian here, also known as Birb, and is only going to be our first technical analyst in the show. So Adrian, would you like to introduce a little bit about yourself?
Yeah. Thank you, Michaela. Well, I'm very excited to be the first technical analysis ever on the show. It's pretty exciting. I'm a CMT, which stands for Charter Market Technician, and this is a designation I earned over the years by participating in the CMT Association program, kind of like getting through different levels of exam, getting the knowledge on the finance, macrofinance, economics, the overall technical analysis, which is a little bit of mystery art, that is similar to where the medical word was in the 19th century. We didn't know at the time where the germs existed. We couldn't see the atoms, we couldn't see the matter, but we knew that something was off about the nature. We couldn't see certain phenomena happen, but we saw them kind of like perform and exist. And similar way we approach technical analysis these days, because there is so much data flowing in on a daily basis. We don't know necessarily what's going to happen in future. We have no way of guaranteeing that. We have no way of guessing continuously what's going to happen in the future. However, there is some sense that we can base our knowledge of, and even despite not knowing the future well, we can truly make money off of it. So this is what I do for a living. This is my main principle that I kind of like try to live by as well. Not knowing what the future holds apparently can still be profitable. So I'm discovering the venues, the ways to incorporate technical analysis, promote it to the world, and at the same time make money off of it.
Great. What about how long have you been doing this? Since when have you been doing technical analysis?
Yeah, so technical analysis, has been in my interest definitely for the past 5-6 years. I mean, my grandfather used to be a degenerate gambler trader. He used to own Bitcoin back in like years ago, like 10 years ago or even more. However, at the time there was no kind of like follow through, no future apparently, because he gave it up. So I only remember, my grandfather, sitting laid up in the charts close, right in front of his screen, glued to the charts, and then observing those daily charts, every day in, day out. And this kind of like, again, just maybe triggered a little bit of my interest. However, it really hadn't been until 2017 that I got it like enough of comfort in my life to make a priority out of learning technical analysis. So 2017, it is the early days of 2017 is where I was lucky enough to get on the market right ahead of the biggest bumps.
Great. I know what a journey, more than any of us now. What about, should we jump directly into the chart? I would like our audience to get as much as possible from you in terms of projections, some educational tips along the way. Again, I have met Adrian a few weeks ago, and I was totally wordless for the knowledge that he has, and I'm sure that the audience will also appreciate this session. So Adrian, would you like to start by breaking down probably top 5 cryptocurrencies out there?
Cool. Yeah, listen, I would start off by showing off the Bitcoin chart, right? This is actually the ETH chart, but before I jump to the ETH, I want to discuss and break it down a little bit for what's Bitcoin USD chart that I'm staying in right now. Hopefully the chart screen is visible, that you're going to see my drawing.
It is.
But what we're looking at here in the chart is the daily chart of Bitcoin USD, coming from the Bitstamp at this point. This is the actual exchange that I'm basing all my charts off, especially for Bitcoin and Ethereum, right? And there is very big importance in using one and the same data vendor, right? Mainly because many different exchanges would have a little bit of different, index kind of like of measuring the prices. So there tend to be a little bit of differences. The tiny differences come from different, again, index readings and different, basically, locations, different time that the Bitcoin prices are being measured. So here, measuring and using one and the same data vendor the exchange issuer, if you will, is very essential. So for me, it's always been Bitstamp. I don't trade on Bitstamp, right? But I just use it for the analysis. So here we're looking at the daily chart. Now, like I said, where each and every single bar, represents a daily session. It represents 24 hours of price action. 24 hours because, well, on the contrary to the regular traditional markets, crypto never sleeps. It's 24/7. So here, having a look at those bar charts, we're going to see those kind of like, poles and two bars on the side, right? So we have the opening price, which is marked basically with on the left-hand side. We have a pole, which is giving us a little bit of a range, inside of a maximum range to the downside, which is the low, and a maximum range to the downside, to the upside, which is the high. And we have a closing bar on the right-hand side, right, which stands for the close. So this is why we can use this kind of like a bar chart to incorporate 4 pieces of data that are relevant for any technical analyst. So we're talking about OHLC, open, high, low, and close. Okay, so this set of 4 pieces of data in terms of, well, the characteristics of how the day looks like, how any period looks like in a chart. This tells us a little bit of, well, perhaps if it's bullish or if it's bearish, right? Bullish means that the open is higher, this is in this case lower than the close, right? That the closing session is higher, the closing level is higher than the open, which is the case right here. Typically, it's kind of like marked as green. If it's to be shown within the candlesticks, because the other way to show where we just see that is with candlesticks. However, when there's a bearish session, we get to see the open on the left-hand side, which is kind of like higher than the actual close, right? So we see this session kind of like drive up the entire value to the downside, drive it to the downside, which again closes somewhere at the specific level of a closing price. And this again just brings a little bit of understanding, in which direction the chart is moving, right? We can either expect and assess, evaluate a little bit of impact to the bullish side or to the bearish side just by the way that a bar or candlestick looks like, right? So just to kind of like show and display, we can also display the chart with the help of the candlesticks, just like I mentioned. So let me just put it up here. And the candlesticks are going to be very similar, right? And and with this difference that they actually just show the body, show a little bit of more essence, show a little bit of more like this merit meat, if you will, right? Because as opposed to the bars, which are basically a set of 3 lines, we are talking about a setup where we have the body, the candlestick body, and 2 knots, one to the upside and one to the downside, right? Both bars and candlesticks represent the very same set of data. So it's again open, close, high, and low. And again, the setup, whether the open is higher than the close or high or closing level is higher than the open, this tells us what kind of like a feeling we get inside, right? Here in this setup, if we get a bullish candle, it means it is orange, right? Otherwise, if we have a bearish selling candle, this tells me that this is kind of like going to be marked and filled with the black color. And this does not necessarily provide much more scientific data, right? Because it's still the same 4 pieces of information, but it kind of like can hint a little bit of more visual aspects, right? If you can tell that there is this entire big, kind of like a selling candle just looking, if I were to show, like, let's take this one, right? Then what it tells me is, okay, there was like this entire sell-off kind of like going on for the entire day, right? From the very moment that this actual open came in, we got to actually just notice the very open being equal to the high, right? Which means that since the very open, there was no attempt to breach above the opening price. It means instead that there was a following sell-off for the entire day, right? So what it tells me is, okay, that there was this very big dominance on the bearish side, of the market, right? The suppliers, the sellers were actually fully dominating the market at the time. And this is also to be showed and represented by almost the lack of knot, the lack of lower candle shadow, which tells me that, again, after opening at the maximum price and falling to the downside for the entire day, the session was closed at its almost minimal level, at its almost low of the day. So this tells me there was like 99 or 100% of full bearish unleashed domination, right? Dominance. There was no kind of like even spark on the bullish side. This was just the bearish. This was just the bears taking over the market, right? Bears taking over the market, selling off. Bears are the sellers in the market, and bulls are the buyers, right? Let's get it straight. And what does it matter? Like, why does it matter? Well, again, it tells us that if there was like a moment of some local declines, right before that, prior to this major selling candle, and this major selling candle actually breaches through like some specific levels that remained unbroken for quite some time, then arguably this may hint to us just a little bit about what may happen in the future, right? Because we know that when certain breakouts happen, when certain moments can come up, that the prices break above or below specific thresholds, specific critical levels, then there is quite often something that we know as order clustering, where people position themselves, traders position themselves with stop losses, with protective stops. So what happens is, this typical rule of thumb kind of like happens that if we have this line, let's say, of support or resistance, which is the line where price action historically has often found, certain like relevance there, right? And then there was like some specific market reaction to it. Of course, the market is going to react, virtually anywhere in the chart, but there is only a couple of levels, a couple of different support or resistance areas that people love to anchor to, and prices tend to gravitate to much more than to other prices, than to other levels. So having this, a little bit of this rule of thumb, that is always said that you buy the support and sell the resistance, right? So whenever the support actually breaks, right, when you buy it and it breaks, this means that there is more likely a follow through to the other side of this line. While it doesn't guarantee anything, of course, for the future, it historically often quite happens, mainly because it is also a self-fulfilling prophecy, right? Mainly because a lot of people see the same thing in a chart, and they use this rule of thumb that if the support breaks, they should close the position. Then by closing the position, they agree and consent to sell off, which actually pushes and pulls the prices lower, right? So this may work a little bit as a self-fulfilling prophecy, but it is one of the major factors why technical analysis works. It does not only mean that it works, but if we know that certain reactions, certain behaviors are learned, certain attitudes are learned, they can be expected. Which means that, again, perhaps we cannot guarantee what's going to happen in the future, but we can anticipate certain reaction from the people, knowing that a lot of them use the very same formula, right? So again, seeing that, a little bit of introductory, if we flip it back to the bar charts up here, what we can tell about the charts is that there are often plenty of certain geometrical shapes, forms, or chart patterns. And on a similar reason, because those chart patterns tend to kind of like be framed within certain support or resistance levels, those support resistance levels can be either horizontal or diagonal, ascending, descending. A lot of people tend to gravitate with their positions, with their anchors, tend to anchor towards these levels. So if we see that at a specific level there is a lot of reaction, and for some reason the prices are consolidating and not really breaking through to the downside, then just maybe it tells us that traders are seeing something in there. We don't know necessarily what that is, right? But there's just maybe traders would expect this level to hold, and because prices truly reflect in the financial markets, they do reflect much more than the present state of the market. They do reflect the future state of the market. The prices are driven by expectations, right? So what we're looking at in the chart of prices, we're truly looking at what the traders are expecting or anticipating to happen in the future. So when the prices are driving up, this doesn't mean there's like some insane fundamental increase, right? It doesn't mean that Bitcoin just gets adopted overnight in all over the planet. It doesn't increase its insane value overnight. However, with this stable value, let's say, or building digital scarcity, traders are anticipating certain moves, which is why what drives their buys, right, which pushes the prices higher, or drives their sells, which drives the prices lower. So all those things concerned, and having just a little bit of this manual guide walk through that, again, the prices reflect what future holds much more than the relevant current state. They're often driven by expectations, and those expectations tend to be set on emotional bias reasons. So we tend to get and approach it emotionally, right? Because why otherwise some traders would see more value or more relevance in the chart for Bitcoin to be at $21,000 than $20,000, right? There is certain way to assess whether the market is overextended or in the upwards direction or in the downwards direction. However, this is a study of its own and on its own. So I'll actually focus here on the chart side. So knowing that the chart patterns exist, we don't necessarily know why they exist, right? Just maybe they exist in the nature, like naturally. There are certain like Fibonacci ratios, in the snail shells, if you will, right? Or in some flower petals or summer, in the nature. So we know that certain patterns exist on their own in nature, but we don't really know if those patterns, let's take this descending triangle. We don't know if it exists in the nature on its own, and it appears and traders react to it, or traders actually make it happen, right? Which more likely than not is the latter part, because people have this tendency to see patterns even when they don't exist, right? If we see two dots, then our mind projects a single straight line because it's kind of like the simplest solution. However, the reality is that it may well be a very, very curved and bumpy road that takes us from point A to point B, right? But our simplest nature on this overall way that our human brains are constructed, it's going to take us from point A to point B, connect those 2 points, this pattern within the straight line, the simplest line. So because of that, we tend to see patterns even when they don't exist, because this is just a simple way to try to understand something. And knowing of that, again, certain patterns appear. And we know that as technical analysts, we can anticipate certain market reaction of these patterns. So let's say following a little bit of this breakout locally here, having this follow up on the breakout, we saw this descending triangle which broke to the upside eventually. And because it typically generates some bullish momentum, some impetus, some orientation in a specific direction, in this very context upwards, it has this tendency to persist in this direction, right? Because this is the nature of trends. Trends are these directional price movements which tend to persist. Not every movement is going to be a trend, though. This is not necessarily a trend. This is not necessarily a trend either as a whole, right? This is not necessarily a trend. Trends happen only 20-30% of the time. So most of the time we see the market move sideways, just the way it does here, and only about 20%, 30% of the time it moves in one direction, specific direction, moving trends. Then it's often followed by another phases of accumulation or distribution, right? That it goes sideways, and then there is like another burst in the opposite direction, imagine, right? So trends only happen as interruptions to this overall noise and sideways period. And having this sideways period going on here for Bitcoin, I would expect that overall, again, it's full of noise. It's full of not credible information, because sideways do not guarantee persistence. Sideways are the very opposite of persistence, right? Sideways mean there's there is going to be a chop all around the specific price levels, right? Often set between two different like thresholds, which is the support and resistance in this case. And well, as long as we move within those patterns, within those frames, within those levels, right, the prices are expected to stay with it. However, if we actually break eventually to the upside or to the downside, we don't know when it's going to happen or when or what it's going to be. But after they finally break, this tells us that there is some valid reason that traders are pricing in higher, well, valuation. And because of such powerful breakouts and heralding effects, many traders tend to FOMO in, tend to get in on board of the same train that is leaving the station in one direction or another, which additionally empowers this trend to persist. So having this overall situation here in the Bitcoin chart, I would argue that we are looking at this major, first of all, dominant primary downwards trend that's been lasting for a year already, the bear market. Then, because trends are fractals, it means that they are kind of like rough. They are not ideal. It means that if you have this primary, let's say, downwards trend, then it's going to be a bumper road. It's never going to be this major one slide down, right? It's going to have a lot of secondary trends to it. And those on this overall direction down, like I said, we are looking at a lot of these, local tides, the secondary tides that are creating this major downside trend. And those smaller movements, as you can tell, are also constructed by those single bars, by those singular bars. And those bars, those days of price action of Bitcoin, are basically telling us something about something that we know as noise or tertiary market movements, daily price action, daily oscillations, which are kind of like irrelevant from the major perspective. So technical analysis is supposed to help us answer the question when potential trend reversal can happen, right? And it does not, again, guarantee anything. It may just hint a little bit about what's more likely than not, knowing the human nature. So here, knowing that, again, we're moving within those frames, within this chart pattern, if you will, right, of this rectangle, this trading range or this range box, whatever you name that, it's not generating any thrust. It's not trending. The market is moving sideways for the past couple of months, right? So this is this medium-term focus. We have this primary downwards trend, also represented by this curve, which is showing 200-day moving average, just like it says on the right-hand side. And we're looking at this major downwards trend, which is actually right now interrupted by a sideways period, right? But this sideways period is still part of this major decrease. So we have the primary bear market, secondary market is set towards sideways, and locally we're moving upwards. And this upwards, this increase, this ascent is an actual result of this breakout over this descending triangle. So I would argue that if we are to take anything out of this, then we know that traders like to anchor around specific targets. People love to have certain numbers in front of their eyes because, this kind of like erases and takes this insecurity, this uncertainty out of them, right? We love to anchor towards specific numbers, and even more so, we love to anchor towards round numbers such as $20,000, $10,000, $30,000, $50,000. And knowing of this effect, knowing that there is specific support and resistance that historically have been found to find certain market reaction off of it, I would argue that we may see potentially a little bit of resistance layer as soon as we approach this upper region of this rectangle. So this 200-day average, 200-day mean area tells me that based on the past 200 days, the average Bitcoin price is actually set to be somewhere around $24,500. 24,000, let's imagine, let's approximate it. $24,000, right? So this is the long-term moving average, long-term average price of Bitcoin. So there is a little bit of condensation, consolidation, if you will, of two different approaches. We have this resistance approach from this rectangle pattern, and we have the support. And we have this idea supported by the 200-day mean, right? So the resistance typically works that if we have the moving average, then the prices, if they oscillate between, then there is this phenomenon called mean reversion, that the prices tend to come back and revert back to the mean. From the downside to the upside in the mean direction, or if the prices deviate heavily against the mean, because this is what happens, right? Traders drive the prices off of their average fair levels, fairly high to the upside and fairly low to the downside, or even unfairly at times. But the fatter it deviates against the average, the bigger the pressure there is, the bigger the tension, let's say, and the disparity kind of like taking the prices a little bit like a gravity center, you know. So if we have this average value, the prices are going to oscillate on both sides of these averages, and often this moving average is going to work as a support and resistance. This is mainly because, well, first of all, it's a fair value, it's a fair average, it's a fair value, and arithmetical average over the large piece of data can be considered fairly accurate. Not so much about when you have three different elements to compare and take an average out of that, but if you have the sample size of 200 pieces or 500 pieces, then if you take an average out of that, it's giving you a fair estimate of what the expectations can be. So, knowing of that, again, that technical analysis would work in a way that traders would anchor and gravitate towards specific frames levels because they believe it has certain value, assigned much more than any other level. There's an expectation to be had, just maybe, that if the support holds, here at around $20,000, again, a round number, then psychologically, the traders would anticipate and would be more likely to expect the price increase. However, this is often interrupted by some events that are happening outside of the chart, because technical analysis is a very cool tool to give you a detailed look of what's happening inside of the market. Right? So imagine this is the market, this is the Bitcoin USD market, then technical analysis gives you a detailed look inside of the market, right? It kind of like lets you just see a little bit, see just a glimpse of what's happening inside the part, inside of the market. However, it does disregard what's happening outside of this market. It does disregard this entire environment, economic environment, or other markets, which quite often tend to bring a lot of importance as well, right? So right now we are of course talking about geopolitical tensions, Russia-Ukraine war. We are talking about recession. We are talking about highly inflated markets, right, with an extremely high inflation, as the CPI, consumer price index, basically brings 10% or even more, in some countries 1,700% even. So technical analysis doesn't discuss this. It does discuss only what's happening in the market. So it means that in order to take any conclusions out of any charts, we have to be mindful of what's happening outside of the markets as well, right? So the upside increases could at any time be interrupted if there is, let's say, another episode to the war happening, right? War triggers fear, fear triggers sell-offs on the markets. So assuming that, there is no expansion no escalation on the war side, there is no sudden shift in the regime that the Fed manages their monetary policy, I would argue that Bitcoin may see a little bit of an increase towards $24,000, which is a fairly good estimate of what the expectations can be, knowing that TA works as a self-fulfilling prophecy and that a lot of people are likely going to look at the same numbers. So this is assuming, again, that this upward trend continues. However, of course, nobody said or gave any guarantee that it's going to continue upwards. Just maybe it's going to fail, right, and take us even lower. Like I said, if in case there is some fear trigger, in case there is some minor capitulation, something that we cannot predict with the charts, then who knows, maybe we can go and just drop lower to like $10,000. Nobody knows that. That's the cue. Should I continue to Ethereum chart right now?
Yeah, please. And after Ethereum, if possible, I would like to start wrapping up with a few advices for people. In general, the do and the don'ts in technical analysis, I will say. I really think that that's going to be a very good conclusion for this webinar. What are the do and the don'ts that traders which are beginning in this path of being technical analysis need to follow?
Makes sense. Makes sense. You can still see my all the drawings, right, when I put it in the chart.
Yeah. Yeah.
Cool, very good. Let me play the Ethereum chart there. So notice on the Ethereum chart that the situation is looking a little bit different, however, still relevant. Right, still relevant to use the very same tools, still relevant to use and try to anticipate similar reactions. But there is this pretty cool difference, this disparity that I will look at. So Bitcoin is fairly distanced against its 20-day moving average, right? If we take it by the percentages, well, it's going to tell us that it's basically missing about, almost 15, 17, maybe 18%, just to revert back to the mean. Then if we take it to the Ethereum chart, what it's going to tell us, the Ethereum chart is actually showing that, well, we are not 18%, but 3% or 4% deviated against the moving average, right? So the long-term value of Ethereum is much more closer, is much closer to what the current value is. So the current values are closer to the actual long-term fair value that is expected. For Bitcoin, it's about 17-20% to make up, right? So we can tell that if we were to compare Bitcoin and Ethereum, then I would argue that this tells us and hints that which one is stronger, right? And in this comparison, Bitcoin and Ethereum, the pair that is stronger is basically pointing at Ethereum, right? It's much more bullish than Bitcoin, mainly because it's closer to its long-term value, right? So having said that, well, we are almost reverted back to the mean. This mean reversion, again, the further we deviate to the upside against the mean, the more sharply, most likely the descent is going to look like. And the less deviated we are, then I would argue that this, well, just not only pulls the price back to in its fair place, but it also tells us and hints a little bit of what may happen, well, in the near future, right? So again, we can go and pull out, different kind of like trend lines, just maybe, and connect different troughs and peaks to see where the potential, where potentially traders would see some price reactions. We can do it on the local basis as well, right? We know at the same time that we're also moving within these frames, within this fixed chart pattern up here, right? We are moving fairly between two levels of $2,000 and, well, approximated to $900, right? So similar to Bitcoin is moving between 17,500 and 25. Ethereum is moving between $900 and $2,000. So being somewhere at 1600s approximately, is definitely much closer to the upper side of the resistance of this overall frame that may generate a lot of price barriers up there. But it also tells me that if traders are to have enough willingness to break to the upside, to break this fair value and to kind of like expect that Ethereum in future is more expensive than its fair value right now on 200-day average, then the prices are going to elevate higher. And if that is an actual case, then we may see, well, something that we would refer to as a breakout. And those breakouts, like I said, because they include a lot of order clustering, many traders tend to anchor, like I said, at specific levels and assign some specific value to it. So it means that there are likely going to be some orders layered around the highs. Same way up here. And when those orders are proven wrong, when they are filled, when the traders are kind of like stopped out, on the protective stops, then it generates this opposite thrust, this breakout situation. And this breakout situation puts the market in its mode of a trend. And those trends tend to persist. So I would argue that if we see an actual breakout and we do maintain those prices for a couple of days, that the chances are we may actually just surpass this resistance of $2,000 and maybe just blast up higher, right? Again, we don't know that if it's going to happen, mainly because those price levels dictated by the moving averages are often working as support resistance levels, right? So we may early expect that as we approach closer to this 200-day moving average, to this resistance, then the price barrier with opposing force, with the selling pressures, basically is going to appear. If it doesn't appear, then good for the bulls. If it appears, then what's going to happen is most likely we're going to have a little bit of a distribution phase where the profits are consumed, where the price pressure from the buyers is countered and met by the price of the sellers, who have their resting positions up here to take profit or to sell off. And it means that there's more likely than not high chances of us seeing a little bit of retracement as we approach the 100-day average. But if the buyers are to be proven stronger, then I would argue that an actual breakout may come. And in this overall thrust momentum building up, I would argue that the chances are that we may actually just see the blast of over $2,000. However, it's conditional. But I think it's looking much better than Bitcoin does right now.
It is. Actually, our time is just up, and I wanted to really give people this do and don'ts. But I will I will organize a second session, because now that we have covered all the in and outs of technical analysis, I will say, and of course this is just 5% of your whole knowledge, right? Probably our next session could be do and don'ts and your lessons as a trader, because as everyone, I think that you had quite a journey and everything, and we learned from that journey. Even myself, when I was starting to do technical and fundamental analysis, I commit so many mistakes, but I wouldn't be the trader I am today without those mistakes. So thank you, Adrian. I wanted to just concluding by asking you, what are the social media that people need to follow to be guided by your technical analysis? What are you most active at?
Makes sense. I'm the most active on Twitter, definitely. That's where the most people can catch me. It's at crypto_Birb. Birb with the B at the end, just like bird, but B at the end. At cryptos.
Like your background.
Birb. Yeah, this is for the Birbness, which is my company. So I encourage everybody to go and hit the follow and actually drop some nice comment or question or DM, and I'll try to answer your questions.
Great. What about your current venture? Is your biggest venture in your current venture Birbness at the moment? Is that where you will focus on this year, next year?
Well, the Birbness is a well-established brand already with quite a lot of reputation. We've been doing that as a team of traders, as a team of analysts, helping people understand and navigate through the markets for the past 5 years. We're going to soon celebrate our 5th anniversary, so this is just to show that there is enough of persistence to outbeat the competitors, which 99% of them basically evaporated. The bear market flushed them down the toilets. This is what happens. This is the reality. However, with my beautiful team and of extremely skilled and talented analysts and traders, we help on a daily basis to the people to learn who want to really bid, maybe cut losses, maybe start their trading journey, kick off towards like their financial freedom. Maybe they want to prove something to the world. Well, then we are there giving them the tools and the resources they need. And that's been going on for the 5 years. And this is what the Birbness stands proud for. And that's what we are going to continue doing for the next years to come and decades.
Great. Thank you so much. Again, your analysis is very clean. I wouldn't say otherwise. And looking forward for our next edition. Thank you so much, Adrian.
Thank you so much, Michaela. All the best, love.
Bye-bye.